The objective of this video is to introduce the topic of the stock market to beginners and provide a basic understanding of how it works. The stock market is a platform where companies can raise capital by issuing shares of stock, and where investors can buy and sell those shares. By buying shares in a company, an investor becomes a shareholder and has the potential to earn a return on their investment through dividends and capital appreciation. In this video, we will cover the basics of the stock market, including what it is, how it works, and how to invest in it. We will also discuss the potential risks and returns associated with stock market investing and provide valuable tips for beginners on how to start investing in the stock market. The goal is to give you a solid foundation for understanding the stock market and to provide you with the knowledge and tools you need to start investing with confidence. The stock market is a financial market where shares of companies are traded. Shares are small pieces of ownership in a company, and by buying shares, people become shareholders of that company. When a company issues new shares, it typically uses the money to invest in its business and grow. It is important to invest in the stock market because it offers the potential for high returns over the long term. The economy generally grows over time, and companies generally benefit from this growth, which can lead to increases in stock prices. Additionally, stocks offer the possibility of receiving dividends, which are regular payments of a portion of the company's profits. It's important to note that investing in stocks is high risk and there can be large fluctuations in stock prices, both up and down. It's important to do your own research and understand the risks before investing in stocks. Stocks are traded on stock exchanges, such as the New York Stock Exchange, NYSE, and the NASDAQ. Stock exchanges function as organized markets where buyers and sellers come together to trade stocks. When someone wants to buy shares, they will contact their stockbroker or use an online trading platform and make an offer at the price they're willing to pay. If there is someone willing to sell the shares at that price, the transaction will be completed and the buyer will own the shares. If not, the buyer can make a new offer at the price they desire. The price of stocks is determined by supply and demand. When there are more buyers than sellers, the stock price tends to rise. When there are more sellers than buyers, the price tends to fall. Additionally, external factors such as economic and political news can also affect stock prices. It's worth noting that stocks also trade in the secondary market, where they have been issued and traded before. In the secondary market, the stock prices are determined by market behavior and the existing supply and demand. Stockbrokers are companies that are registered and regulated by financial authorities, which offer services for buying and selling stocks. They generally require an initial minimum investment and may charge commission or custodial fees. Some stockbrokers also offer stock analysis and consulting services. Online trading platforms are an easier and more accessible way to buy stocks. They generally don't require an initial minimum investment and charge lower fees than traditional stockbrokers. Some platforms also offer access to other types of investments, such as mutual funds and bonds. It's important to note that before buying stocks, it is recommended to do research on the company and understand the risks involved. Additionally, people should choose a reputable and regulated stockbroker or platform. Analyzing stocks involves evaluating different aspects to determine if a stock is a good investment opportunity. There are two main types of analysis: Fundamental analysis and technical analysis. Fundamental analysis involves evaluating a company's economic and financial fundamentals, such as its revenues, profits, cash flow, debt, and book value. This allows evaluating if the company is financially healthy and if its stock price is justified in relation to its fundamentals. Technical analysis, on the other hand, focuses on the stock's price and trading volume trends, using charts and indicators to identify patterns and buy or sell signals. To find reliable information, it is important to read financial reports and news from reliable sources such as financial newspapers and news websites. It is also important to verify that the information is objective and not being used to manipulate the stock price. Additionally, it is recommended to consult financial analysts and other experts to get a more informed opinion on a stock. Investing in stocks involves risks and potential returns. One of the main risks is market risk, which is the risk that the stock market as a whole will decline. This risk is present in all stock investments and can't be avoided completely. Another risk is specific risk, which is the risk that an individual stock will perform poorly, regardless of how the market as a whole is doing. This risk can be reduced by diversifying a portfolio across different stocks and sectors. When it comes to returns, stocks have the potential for higher returns than other investments such as bonds, but also carry higher risks. Historically, stocks have provided an average annual return of around 10%. To manage these risks, investors can use different strategies such as diversifying their portfolio, investing for the long term, and regularly reviewing and rebalancing their portfolio. It's also important to have a clear understanding of the risks associated with the stocks in which they are investing and to not invest more than they can afford to lose. Additionally, investors can also use risk management tools such as stop-loss orders to limit their losses on individual stocks. Diversify your portfolio. Don't put all your eggs in one basket. Diversifying your portfolio across different stocks, sectors, and industries can help reduce specific risk and improve overall portfolio performance. Invest for the long term. The stock market can be volatile in the short term, but has historically provided higher returns over the long term. Investing for the long term can help you ride out market fluctuations and potentially earn higher returns. Keep an eye on the overall market. Stay informed about the overall economic and market conditions, as they can have a significant impact on the performance of your portfolio. Keep emotions out of your investment decisions. Avoid making emotional decisions when buying or selling stocks, such as buying high or selling low due to fear or greed. Start with small investments. If you're new to the stock market, it's a good idea to start with small investments and gradually increase as you gain more experience and confidence. Have a plan and stick to it. Have a clear investment plan and stick to it, regardless of short-term market fluctuations. In conclusion, investing in the stock market can be a great way to build wealth over time, but it's important to understand the risks and potential returns associated with it. We've covered the basics of stock market investing, including what the stock market is, how to invest in stocks, how to analyze stocks, and the risks and returns associated with it. Additionally, we've provided valuable tips for beginners on how to diversify their portfolio, invest for the long term, and stay informed about the market conditions. It's important to remember that investing in the stock market is a process of continuous learning, so it's essential to keep educating yourself about the market trends and financial news. By following these tips and being disciplined with your investments, you can potentially increase your chances of success in the stock market.